Alrighty, so today let's talk about taxes. Now, taxes are something that, well, I guess they're just unavoidable. So I'll start off by saying that. And also, too, it's one thing that's funny is a lot of times people say, "Gosh, I wish somebody taught us about this in school." Well, I'm here to kind of say, yeah, it's a little complicated, but it's not overly complex. That if you don't dedicate, I'm going to say a little bit of time to it, you can learn it very, very easily. And that's what we're going to try and do here today is kind of take you through the basics of the tax brackets, kind of how taxes work from an overarching philosophy and so forth, and give you a little more details on that. With me, as always, is Harrison Johnson, our CFP, to kind of break down how things work on the tax side.
Yeah, absolutely. One of the things that I do with all the people I work with is I do an overview of how taxes work. Taxes are a really big part of financial planning, and if you understand how the game works, then you can do a lot to reduce your current and future tax liability. And so, it all starts with understanding, what all the different lingo means, how the tax brackets work. So that's what we want to go through with today. So, um, you know, First off, when you look at your tax return on the federal side, you file a Form 1040 is what it's called. And essentially, the first page of that 1040 lists all the different income sources that you have. So you might have some wages, interest, dividends, capital gains, IRA income, Social Security income, pension income, rental income, all kinds of different income sources are listed out. And so the way it works is you add all those different income sources up, you get something called an adjusted gross income, or AGI. And individuals like us, we have AGI. The similar term, if you're a business, you have revenue. So AGI is basically like revenue for individuals. And so you have your AGI. From there, you subtract out either the standard deduction, is what it's called. Right now, for a married couple in 2023, the standard deduction is $27,700. Basically, that's like an expense that any married couple can claim, or you can do what's called itemizing your deductions, which means you add up all the mortgage interest you have, state income taxes, property taxes, charitable deductions, and medical expenses. And if all of those add up to be greater than $27,700, then you can claim those itemized deductions instead. So AGI minus these deductions. These deductions are basically like expenses for individuals. And after subtracting out those deductions from our AGI, we're left with taxable income. Taxable income is like our profit. This is the number that is actually subject to taxes and what gets applied to the tax brackets. And so if you're a married couple, we look at this little box up here in the upper left. So if your taxable income is, let's say, $100,000, that is going to put you in this third federal tax bracket. So the way it works, you have taxable income of $100,000. The first $22,000 of that 100 is going to fill up that first bracket. It's going to be taxed at 10%. Above 22, up to $89,450 is going to be taxed at 12%. And then the income that you have above that, up to the $100,000, is taxed at 22%. So of the taxable income that you have, different chunks are taxed at different rates. So what that means is more income is always better than less income, everything else the same, but the more income that you have, the higher you climb up into the tax brackets and the more progressively it gets taxed. So for example, one thing people will look at is say, well, the bracket between the 12 and 15% tax rate is $89,450. That means I don't want to make above that. Well, if you do make above that, only the income that you have that's above that rate will actually be subject to the higher tax rate. So again, more income is always better than less income. Now, when we look at tax planning, from a simple perspective, when we're looking forward at the different, taxes that we're going to be paying, the goal is really to try and keep your tax bracket as low as consistently as possible. So that's something that really hurts people is, maybe they have a year where there's a lot of unexpected income. Maybe they sold a property. Maybe they had a bonus. Maybe they were working two jobs for a little bit, and that pushed them up into a higher tax bracket. You never want to be pushed into a higher tax bracket that you're not normally in, because overall that's going to, hurt you on the tax side. You want to try and stay as low as you can, but as consistently as you can. Something else to add into this, when you look at this little bracket, we see below that there's a different rate for capital gains and dividends. So essentially, you invest in stocks and you have capital gains from the growth of those stocks, or those stocks pay you dividends, that income is taxable, but it's going to be taxed at a different rate than all your other ordinary income would be, like wages and interest and pension and IRA and that type of income. So if you look at the tax brackets here, right around $90,000 of income, $89,000 of income. On the ordinary side, we go from 10 and 12 up to 22 and 24. But on the capital gain and dividend side, we go from 10 up to 15. So that's an important little threshold. And if you can keep your income below that, essentially any capital gains and dividends that you get will be tax-free on the federal side, in addition to the other income that you have. Once you go above that, you go into the 15% bracket. That lasts all the way up to $553,000 of taxable income. And then above that, you go up to 20. So when we're looking at creating income streams, capital gains and dividends are a nice source to have, because they're always going to be taxed at a lower rate than the ordinary income counterpart is going to be.
Yeah, and one thing to just kind of summarize, recap. I mean, obviously, there's a lot of numbers here to kind of consider, and I just think the big thing for people to understand is the difference between AGI and taxable income. I mean, use that $100,000 taxable income. Let's take it one step further and say, if you had $100,000 worth of, let's just say, W-2 income, that's what you and your wife or husband pulled together, and that's where we're at. That is your AGI. But you take that 100,000. Now you're married, filing jointly. Now you subtract 27,000. What is that? 27,700. That becomes your taxable income. So don't think because you make 100,000 means that you're in this 22% tax bracket. You subtract that standard deduction. That's your AGI. That would actually push you down into that 12% tax bracket. And that's really where the benefit of tax planning and understanding how the brackets actually work can really come into play and help you save money on tax, which I know a lot of people want to do at the end of the day.
Yeah, and you're exactly right, Chase. $100,000 of income minus 27.7 means your taxable income is really like 72,000. That's all in that second bracket. And so by understanding the bracket that you're currently in and then projecting out income that you'll have in the future, you'll be able to recognize the different tax brackets that you'll go into over time. And that is the key to understanding how you should be saving and investing in money along the way. When to put money in pre-tax accounts like your 401k, when to put money in Roth accounts, when to realize capital gains, when to sell property, all of those things that influence your income. You have to first start at understanding your AGI, your taxable income, and what bracket that you're in, so you know how to structure the assets and income sources that you have.
Yeah. I mean, as you can see, I mean, taxes are a huge part of planning. They're a huge part of your financial life. And as I said at the beginning, they're unavoidable. You're going to have to pay taxes at the end of the day, but knowing how the brackets work and essentially how to play the system and how to play the game is going to be what ultimately results in a better financial outcome for you, your family, whoever's involved there. Now, I did want to say, you mentioned the pre-tax versus Roth and so forth. I'm going to tease here a little bit, because going forward, there is going to be another video. We're going to actually break down Roth, traditional, that pre-tax account, to kind of show you how that works, and we'll relate that back to the tax brackets, because it is so important.
Yeah, exactly. I mean, a lot of people look at that and say, well, I like pre-tax because I want the tax deduction now, or I like Roth because it grows tax-free. And the truth is, it's great that we have the option to choose, because for every person in every situation, it's going to be different on what is most efficient for them. And again, you find which path is best by understanding your tax situation and how your tax situation is going to change over time.
Yeah, it's a huge basis for how you should be making your decisions at the end of the day. Doesn't always mean you make a tax decision over an economic decision. We'd always tell people we'd rather have you make money and pay taxes than make no money and pay no taxes.
Mm-hmm.
That doesn't mean you want to pay taxes just because. You want to have a good plan in place to reduce the taxes as much as feasibly possible. So I hope this video was helpful. And as I said, we'll be doing more of these videos, especially that pre-tax traditional account versus Roth in an upcoming one. If it was helpful, be sure to subscribe to our channel, and look forward to talking to you soon.